All right, thanks for joining us today, everybody. We have a very special guest. I'm excited to have Mary Childs with us today. She is the author of The Bond King, a recent book she wrote over the course of, I think, 8 years, researching the life and times of Bill Gross and PIMCO. She's also a co-host for NPR's Planet Money. Previously, she was at Barron's and the Financial Times and Bloomberg News. So, Mary, thanks for joining us.
Thank you so much for having me.
So I want to dive right into this book. For anyone who hasn't read it, it's generated quite a bit of attention, both for the depth and quality of the research and the writing, and also, I think, frankly, for the oh my gosh factor that a lot of people have when they read it. So why don't you, I'll be honest, like when I picked it up, I was very skeptical. I'll be totally honest. I did not plan to read the whole book. And so with a book like that, I will generally skip to the end, right? So I actually read the epilogue and your author's note, and I couldn't put it down. I was like, wow, this is actually pretty stunning. So I'd love to hear, you kind of explained it a little bit in that book. I'd love to hear you tell everybody about how the book came about, how you went about writing it, and particularly, it seems like everybody wanted to talk, most people only on background, but Bill Gross himself cooperated to a surprising degree. So I'd love to just hear a little bit about the genesis of writing the book and what it was like.
Sure. So I started out covering PIMCO in 2014 in April. And, I was a reporter at Bloomberg News. I was a beat reporter. This was my full-time job, was covering asset managers, including PIMCO. And, at the time I thought that the fireworks were kind of in January when Mohamed El-Erian left. And then there was this big, enormous Wall Street Journal article in the subsequent weeks, and Bloomberg too, and a couple others where, the truth of why he left came out. And I was like, oh, kind of a bummer to be arriving in the aftermath. But of course, more was brewing. And so I kind of was able to write this book in large part because I was already halfway in the door, both from, in part from having come from Bloomberg News and been covering credit. I had been covering credit for years by that point. So I had kind of the language and understanding to be able to, start talking to people and demonstrate that I understood what they did. But also because people were already talking to me about PIMCO. I was already like building sources by the time Bill Gross was famously fired in September 2014. So, reporting on it was super gnarly and difficult and required a great deal of handholding and coaxing and people who, PIMCO is famously litigious. So there's a real obstacle there as a reporter. If I reached out to someone, who's still at the firm, they would immediately send it to communications, right? They would send it to the PR department. And I would just be like, oh, hi again. The PR guy would be like, Mary, you've been trying to message people again. And I'm like, yes, it's my job. And,
right.
And I would get scolded and we would, resume our interactions. But just having that kind of foot in the door from knowing some of the things that were going on, it made it a lot easier when big events like this happen, everybody clams up. Everybody kind of shuts up and doesn't want to be the person talking to you. So you really can only, again, get your foot in the door by having a sliver of information already, by already knowing something. And sometimes that was just like this, I'm going long. Is that... I'm giving you the really long version here.
No, this is great because, the two things that stood out to me were that one, it seems like once the dust settled and people had a little bit of distance from it, everybody wanted to get their thoughts in, at least on background, right? And then I was stunned with Bill Gross's relationship himself with when the famous episode where I think he called a Reuters reporter and just started...
Stunning.
Yeah, it was like, does he really not get how this works? Like, I'm stunned at the number of people who don't seem to understand what on the record and off the record means, right?
The thing there is Bill knows. Like, that's the confusing story about, that I think actually it's not confusing. It's more just indicative of his state of mind, right? Where he, better than a lot of people who are in the, similar position, he understands the rules. He understands how media works. He's been doing this gig forever. He better than a lot of people. He's like I've been trying to express, I don't really know how to explain like why he's a better interviewee than a lot of, comparable billionaires or comparable, powerful CIOs. But he has this kind of understanding of the rules. But in that moment, he just, the moment we're talking about, he calls Jen Oblan at Reuters. He's pulled over on the side of the highway and he just starts talking about like, Mohamed El-Erian wrote that Wall Street Journal article, which of course he did not. And, he's got you wrapped around his little finger and just kind of going off about how Muhammad was getting the better treatment in the press, and his story was getting his story was the one in the mainstream, and Bill felt like he wasn't, he was kind of getting short shaft. So, what is the saying? Short straw, short stick.
Right.
I don't remember. Sorry for the edit there. So Bill felt like he wasn't getting the same audience, and so he calls Jan Oblon and says all this like kind of bananas stuff, and
that he had agreed not to talk about, right?
Right.
I mean, that
exactly.
was,
exactly.
I mean, they had an agreement between them in the separation agreement, and he just kind of threw it out the window because he was frustrated or lost his temper. Yeah.
Exactly. So you can see just how upset he is in that moment, because it's not how he would normally act.
So do you think this goes back to, one of the things that really jumped out to me in the book was the two kind of, I think they're true, maybe they were apocryphal, comments about what it was like to interview at PIMCO. So Ben Trosky, one of the high yield executives there, used to say that the new hire interview should be two questions. One was, were you abused as a child? And two was, did you like it? Which is just like a unbelievable thing on its own. And then Bill Gross's actual interview question, apparently, which I thought was less shocking but more thought-provoking, was, which would you like to have the most, money, power, or fame?
Right.
And that most people always said money or power, but that he was obsessed with fame from the beginning. My motivation was always to be famous. So do you think that, like, one, I'd love to hear your thoughts on that. And two, do you think that part of this downfall, I'm kind of skipping to the end here, but when the meltdown happened, do you think it was because he realized that the fame wasn't as useful as he thought it was, or that there was some other psychological issue going on here, or as some people speculated that he was just kind of losing it, or that he was always like this and power and money kind of revealed his true inner self? Or what are your thoughts?
A lot of people do think that he was always like this, but a lot of people also speculated about the losing it. So I can't possibly speak to that. I feel like I would need to have a lot more credentials to speak to that.
Yeah.
But I he has, if you talk to people from like the olden days, they don't see that much difference in his behavior. It's who he was surrounded with that different people, acted differently around him or treated him differently. And to some extent, it's that like his peers had retired and had moved on, and he was kind of the guy left standing at that point. And I think that was hard for him, where, the old guard had kind of known how to work with him, known how to interact with him, and had worked around him in a way where he's not the most like, extroverted, pleasant person in the universe. And that's fine. That's who he was. But I think there's also this weird thing that I keep thinking about, like, how do you know when you have power? Right. I think that, after a while, all of the old guard had fallen away and everyone around him was smaller. And I think that was a dynamic that maybe he didn't notice or appreciate, but he was this Bond king on a pedestal. He was this legend. And so, in the 80s and 90s, if he didn't want to make eye contact with his peers, the Chris Dialanis's and Ben Trotsky's and Dave Eddington's of the world, they were more forgiving of it. Whereas I think, they understood him and they had taken the time and had the ability to understand him. And then, the same behavior in the office, if there's some, upstart 25-year-old who's like, hey, Bill, they're going to interpret it differently. And I think, I don't know, I think that's both like, perhaps not appreciating how his power and his influence would have changed those dynamics. But also that's for sure, we should say he's neurodivergent. He has gotten a late in life diagnosis as having Asperger's, as being on the spectrum. And I think that that's super relevant to a lot of the kind of interpretation of his behaviors. Like, there's a little bit of a difference of opinion. I think he doesn't think that he was a jerk. I think that he thinks that he didn't want to interact with people the way they wanted to be interacted with.
Right. Yeah. He wrote some very introspective things in some of those investment outlooks, right? Like basically, am I really a jerk kind of thing? And it was kind of soul wrenching, I guess, in some way. But I mean, to the point about the people who interacted with him previously, and, the turnover was reasonably high amongst other people, right? I mean, he had a long tenure there, but I think it was difficult to keep people around him at the leadership level. So, I mean, if you had asked me, even before this, it would have just seemed impossible that there could be any sort of orderly succession plan here. Right. I mean, it's hard enough at any firm. I think if you look at any big company, particularly a founder-led company, but especially in the investment world, the base rate of successful succession plans is close to zero, right?
Right. Like, can you think of one? I think there's one firm in Texas that did a good job.
Yeah, there's very, very few, right? I mean, in the hedge fund investing bond market kind of world, like, I struggle to think of any that have really, really pulled it off. I mean, particularly with such a dynamic, face of the firm kind of thing. So completely. Do you think they were ignorant to that, or they just didn't care and just kept trying to force a square peg into a round hole?
I mean, what else can you do? Like, you're supposed to have a transition plan, like a succession plan, and everyone is mortal. Like, you have to do it. Bill's not going to be, he couldn't have led PIMCO forever. He couldn't have been, at a certain point, you have to come up with a plan and you just have to try it. There's just no world in which everyone stays forever. And Bill knew that. I think, he wanted to try to come up with a plan. It's just that they always were never on the same page. And every time he seemed to be able to put forward a plan, it was like the plan that they just had decided wouldn't work, So to some extent, I think it's impossible, but also mandatory. And that's why you end up with all these firms that can't do it, that struggle with it.
Right. This is actually a little bit of an aside, but there's actually a very good history in the book, I thought, of the financial crisis, the kind of mid 2000s through 2009, 2010 period, which I thought was really, really good because it's rarely covered, I think, as much from the bond market side as it probably should be. The broker dealers get attention and the equity markets get attention, but it was a bond market problem as well, or even primarily. Do you think PIMCO's involvement, and it was at the same time as a lot of other firms, right? I mean, BlackRock notably and others, but do you think their involvement in the process and in DC was a net good thing for the markets and for the country, or was it kind of a regulatory capture kind of situation, as the critics might allege?
Oh gosh, it's hard because I feel like the system that we've set up, and I don't know of a better one, so forgive me. The system necessarily intertwines the two, right? Intertwines markets and government. And there's always going to be some intersection, right? I don't know of a free market anywhere. So I think that some of it's just a baseline. We've chosen in this country and in I think every country to engage with markets in some way or another. And I do think it's troubling the extent to which we, I think at the time there was this idea that, they're helping us. Someone needs to value these securities and they know how, and that's good. And we need experts. And certainly we've seen a turn away from experts for better or worse. But it's also like, the regulatory capture thing, I think, has really stuck in people's minds. Maybe not in that phrasing, but the idea that, it's rigged and these relationships are, the people in government are just waiting to go through the revolving door and get a really cushy gig, making $1 bajillion at these firms that they're now pretending to regulate. Like, that's so problematic and just feeds the mistrust of all of the systems that we have. So your question's funny because it was like, is it good for the markets? Is it good for society? And those are two distinctly different things. And I think the answers are different,
In a narrow sense, they are. They're totally different. But in a broader sense, I think this is why you've seen such a breakdown in trust. And in an indirect way, we had Spencer Jacob on a few weeks ago about the meme stock stuff and about how it's just unthinkable that people could rise up in this way to take on the man when it's really, I know, right? But this is where we've gotten to, is I think if a layperson were to read this book, somebody who had no experience in the bond markets, I think the things that would stick were that sort of episode, along with just the cultural dysfunction and the personality extremes that were going on inside the company. And so, I think it really does generate a lot of attention when people see that this big, powerful billionaire is kind of pulling strings behind the scenes. It just raises the question, right?
Yeah, absolutely. And I do think you're talking about these big personalities. And one of the things that struck me, I don't know if this was naive, maybe it was, but I feel like I thought that grownups were a little bit more grown up. And I think I thought that I expected our systems at least to be better than ourselves. And that in retrospect, I think was naive. But both that the people, that this book concentrates on acted in kind of petty and childish ways. We pay them a lot of money to keep it together and to, shoulder that mantle of fiduciary duty and this enormous responsibility of our financial futures. And, in the future sense, not in the derivative contract sense. But I feel like that was disappointing, I think. And I started out writing this in my 20s. So part of that is just like regular disillusionment. But I don't know. It seemed like we've entrusted such important things and we're giving them over to, people that aren't better than us.
Yeah. No, it is. I mean, everybody, I think, has that moment where they realize that their parents are imperfect, or that the billionaire down the street maybe has a lot of the same flaws that we do. And I think that's a lot of the things that will also stand out from the book. I mean, a couple of things that I wrote down that jumped out were Neil Kashkari, who had a very prominent role in DC and then came over to PIMCO for a few years, was notable for saying thank you when a lower level person in the organization held a door open for him. And the immediate reaction from other people was that this guy will never make it here. And there were other anecdotes that grown men were brought to tears in front of Bill Gross and the investment committee. I mean, first of all, those are kind of astounding anecdotes, and I'd love your thoughts on them. And secondarily, was there anybody who took the other side and was like, oh, it really wasn't that bad? There was like some isolated, horrible behavior, but the place wasn't really that terrible?
I mean, yes, I think if you're in a different department, like if you're not on the trade floor, you could have had a more lovely experience. So I do think there was some subjectivity, or like if you worked with Jim Muzzy in client services and you were somehow insulated. People tell me that. Everyone's tolerance is different too. I should note, like after the book came out, someone emailed me and he was like, I really take umbrage with your characterization that, it was a jerky place and that everyone was so mean and that we were like so intense on the floor. And the email like went on. And then at the end, the guy's like, yeah. And like people came in from Goldman and we chewed them up and spat them out or whatever. And I'm like, I think we're saying the same thing. Like, I think I said what you said and you said what I said, but you liked it and I wouldn't. And that's fine. That's what makes a market. I didn't work at PIMCO and it's great. So I think the crying and the lack of kindness, I think maybe to some extent too, that's reflective of an old approach to how we conduct business. And maybe we're renegotiating that right now. I don't know to what extent that's reached Newport Beach. I'm kind of curious to find out what happens, if there is kind of if the reckoning of, what we show up to with at work and what we expect from our employers and our coworkers. I don't know how different things are, but I do think this like Solomon Brothers approach is not inclusive, for sure. Yeah, and so damaging, I mean, no offense to old Solly guys, but it seems like it was deleterious to mental health. And I think we take that more seriously now.
Yeah, I would think we probably do. I mean, and it'd be interesting, right? If you go read some of the anecdotes from Liar's Poker, right? Which was written, 35 years ago versus some of these anecdotes, which took place 10 to 20 years later, maybe. Yeah. And there's probably a little bit of positive evolution, but there's still a long way to go where a lot of this stuff, it would be hard to imagine a big reputable firm like PIMCO getting away with it for the next 10 years, right?
Right.
I don't know.
Completely agree. Yeah.
But it goes to some of the feedback that you got. You posted something on Twitter, which I thought was fantastic. And it was kind of, I guess, unsolicited feedback from someone who said that he or she really applauds the time and effort and the journalistic excellence that you put into the book, which I think is beyond doubt for anyone who reads it, but the person thought that the book was a waste of time because it revealed how self-centered, misogynistic, selfish, and despicable people can be. I hope your next book is a positive one.
I know.
And, I guess my response to that was, that's true. Like, I can totally see, again, how someone would read this and just become even more entrenched anti-Wall Street, billionaires are evil, blah, blah, blah. But at the same time, this was a story worth telling, in my opinion, if you have any interest in how the world functions, because again, the bond market is a huge thing and it's an important thing. And whether you like to acknowledge it or not, every human, every citizen of the United States, at least, is impacted by this market. And it matters.
Thank you. Exactly. And I feel like I get it. If you're turning away from like the news and you read a book and you're hoping to escape in some way, like, this is not the book for you.
No.
This is not Harry Potter. And no. I can't tell you like this. Yeah. I thought this was funny and like kind in some way. He obviously was, it's nice to get the accolades about the journalism being good. Thank you. And I get it. Like, yeah, you read a depressing book that's like, just leaves you kind of feeling dirty and I don't know, unsettled. But you're right. Like, if you want to know the world that we're in, you have to understand these systems. And that's what we do at Planet Money too, right? We like want to explain the systems, like these things that are made up of us and going on and influencing everything around us that are difficult and complicated. And like, if you don't have that bridge to understand what's actually going on, I don't know, like, I don't want to be just reading Harry Potter or whatever, nice, happy fairy tales, because I need to know what's actually affecting me. Maybe it's my retirement account, but maybe it's the entire governmental, organizational, like decisions that I don't know. I think that you're right. This affects everyone in the United States and outside. And it's so crucially essential, foundationally. I can't overstate how important it is to try to understand these systems and to try to be a participant and like weigh in on what's going on and what's affecting you.
Yeah. So that's why I thought the criticism was a little bit unfounded because of that. And I also thought that, look, if you wanted to exploit this, which is frankly what I thought you were going to do under false pretenses when I picked it up, because this could have been like a 300-page. Yeah, it could have been like a 300-page New York Post article, right? Like, there was so much material. Yeah, so much ludicrous behavior that barely got a sentence or two or was omitted. Like, I mean, the behavior in his divorce from his ex-wife, the behavior with the neighbors and the sculpture next door, and like all the little nitpicks, you could have done along the way with the people inside the firm. I mean, you painted the picture, but you didn't harp on it. So I don't know.
Like, thank you.
I thought it was reasonable, but
anyway. It was a lot. I mean, initially, so I think a lot of people were nervous about this book. I know a lot of people were nervous about this book.
Oh, I'm sure. Yeah.
And I got a lot of feedback right when it came out. They all kind of like work stopped for a minute and everyone read it. And people started texting me and emailing me their opinions. And a lot of the feedback was like, well, that was just a list of facts, Like, I think a lot of people thought the same thing, that I would go absolutely ham on it and just say all the mean stuff and like, I don't know, like do curly cues about it or something. And I didn't have to. Like, the material there was just so much to work with in a good way and a bad way. Like it's not really my, it's not my choice. I mean, there's a curatorial element to it. I do get to pick what to include, but at first, the divorce, I was like, oh, that's not really appropriate to include. It's his personal life. I'm not trying to mess with that. But it started to become part of his, public facing persona. It started to become part of like his Wikipedia entry, and it became like journalistic, malpractice to not include that. And then the same is also true of the dispute with his neighbor. That's just, reached kind of astounding lengths. And I think that, I'm not offended at all by the fact that it's a list of facts. Like, that's great. I think you can, if you want to go do your own diligence, if you think that, maybe I oversold something, like go read it for yourself, go look at the underlying material. A lot of it's public. It was a lot. And I think, I appreciate you saying that, because it is, I tried to be as fair as humanly possible and include what I needed to include, but not hurt anybody,
Yeah, I frankly was very surprised that there wasn't more biographical detail, because it's called, the book's about the Bond King, right? It's not about Pimco per se, even though it obviously is. It's about one person. And there really was relatively little about his background and his childhood. No, look, I mean, it's entirely your choice. But I mean, I don't think anybody could fairly criticize you for being overly personal, because there's relatively little, compared to the material that's out there, relatively little personal biographical detail relative to, just a good in-depth coverage of, the way the markets evolved and developed and the way markets are structured and the way things happen. So
I think part of that, I mean, that is like an aesthetic choice to an extent, where I just like never really care if someone's like, I mean, he's from Ohio. He wrote about the Babbling Creek in his backyard. But much beyond that, I'm like, oh, okay. Like, he played basketball. Okay. Like, I just don't need to know that. And I find like a lot of the biographies that spend a ton of time in there, I'm like, oh, he like had a friend. Okay. Like, and then what? Like, so that's a personal bias that I get impatient, but
he played blackjack, right? Just like every other, ambitious Wall Streeter in the 70s, right? It's not that unusual. I mean, he's not Ed Thorpe or something. So it wasn't that friends with relevant. Ed Thorpe. Yeah.
No,
I know. I
in
saw
the mold
that,
of Ed Thorpe. Yeah.
Yeah.
Ed Thorpe is so great. Yeah.
Yeah. But I mean, like, I felt the same way. Like, at one point I was like, is he really going to blame this all on his parents? Because he talked about his, chilly relationship with his mother or something. But yeah, that's the
Don't
kind
we
of
all blame it
biographical
all on our
stuff.
parents?
Yeah, exactly.
I mean,
That's where I just don't find much credibility in it. But one thing I want to jump to before we run out of time, which I thought was really the crux of kind of the conclusion of the book, and that you covered in good depth in an article called "Was the Banking Great?" that you wrote in Institutional Investor. It's dated May 6th of 2020, so just last week. And you give it 2022, last week. Yeah, yeah. We're recording this the following week in May of 2022. And you go into this kind of long, in-depth treatment of whether it was luck or skill, which of course is the crux of any evaluation of any active manager. And I think from my perspective, it's without doubt that he deserves a good dose of credit for being innovative. And we could have a secondary debate as to whether innovators in markets really get too much credit or too much reward. I think that's probably true, but look, it is what it is. I'm not going to quibble with that.
I can't weigh in on the reward of it. Yeah.
Yeah, right. I mean, like, there's a societal question of like, is it a good system if you reward somebody with that level of money for something that was probably to a degree inevitable? He just got there first or slightly better.
Seems like a weird allocation and maybe not an efficient one. I'm sorry to suggest it. Go on.
No, I totally agree. Yeah. So, but it was interesting because in the book you quote him, and I believe it was from an investment outlook that he wrote himself, but he said, all of us, even the old guys like Buffett and Soros, yeah, we too, we've all cut our teeth during perhaps a most advantageous period of time, the most attractive epoch that an investor could ever experience. You wrote then, simply taking risk had made money. And so you kind of addressed that then in this article that you wrote recently, where I thought I'd love to hear you kind of summarize it. Then I'll push back on what I thought were two good points and 2 points where I thought he was a little bit wrong.
All right, let's go. So the II article basically looked at this 2019 study. I mean, I basically say that, I talked to sources. I heard from people who were like, no, I traded alongside him in his markets and I saw what an amazing trader he is. He truly is a great. And I talked to people who, have followed, like anecdotally have followed and have, seen him, over decades identifying these structural factors that he thought would yield better performance and indeed did. And then I came across this 2019 study by these two researchers. It was kind of came across, everyone was talking about it. And it basically identified three of the main factors that Bill Gross was using. And it made a sort of synthetic portfolio using those factors and added a little bit extra for the direction of interest rates and then compared that against his actual returns. And indeed, those three factors, that little kind of fake portfolio, synthetic portfolio, accounted for 89% of Gross's returns, outperformance over the market. And so that's pretty good, right? And then there's like a little extra that that they would call alpha. And I think that this is instructive in a few ways. There's this debate as to whether or not that's like, I've heard exotic beta or alpha, those factors. And I personally think I'm sure I'm missing something in the debate, but I think it's very silly to say that identifying those factors, however many decades ago, was somehow not an insight. To me, that feels, this is like one of the debates in quant investing that like, oh, does this actually count as alpha? To me, it does. I know everyone's wondering my opinion. I'm a world-renowned researcher, but I will say, in my view, this doesn't detract from his legacy. Identifying these inefficiencies, these ways in which he could exploit, how much other people perceived risk, how much other people needed to buy insurance so they could sleep at night and he didn't mind not sleeping, how much people overestimate the volatility or potential risk in a longer duration, in a longer, tenor. So all of these things that I think, seeing those and seeing them early absolutely counts as an insight, absolutely makes him, a great investor. And it's those structural, replicable, persistent, robust factors that to me make a lot more sense than I think tomorrow the Fed's going to do XYZ because I'm psychic. Like I just don't, I've been covering this for a long time and I've had a lot of experiences where people want to like shake me and say, I think this is going to happen, write a story about it. And I'm like, okay, man, like you have a thought and you think that's the story. Like, I don't even even if it's a robust investment analysis, there's like a good justification. Like you didn't predict a war in Russia. You didn't predict, right. Wait, it's not in Russia. You didn't predict the war in Ukraine. There are things that happen in the world that are not on your models. And I feel like those are a lot less fun for me to think about. The structural things that Bill Gross said underpin all of the total return investing that he'd been doing for decades. that stuff makes great sense to me. And that stuff seems to me to be really a true insight. Was that a good summation?
No, very good summation. Yeah. Great. So what I would say that stood out to me was a couple things. So in the article, you talked about his keys to the kingdom. Mm-hmm. And to me, the one that stands, so that in order, they are selling volatility, having a little bit more exposure in mortgage securities and derivatives, holding cash equivalents instead of cash. You said that one source told you that someone pulled him aside and said, there's only 4 things you need to know: going long duration, rolling down the curve, so and taking advantage of a bond's price rising as it gets a little closer to maturity, going long credit, and going short volatility again. So picking those one by one, I would say I agree pretty much with everything you said, but I think one big thing stands out to me, which is that you're kind of compounding your risks there by going long duration and short volatility. And so even this study that was originally out of AQR or some of the folks at AQR where they tried to highlight what Buffett did, which again, I think that paper mostly got it right because it pretty well aligns with what Buffett himself would say, which is that he's trying to find good quality businesses that are going to last. So he wants equity duration on his side. Yep. And that's a very different thing than in the bond market concept of duration. So the paper itself has one big caveat, as you pointed out, which is that these strategies seem to only work in markets that were going up. And if you look at history, anyone who's shorted volatility or sold options of any kind, which is different than owning, the implicit options in mortgage securities, but anyone who's shorted volatility and taken these kind of compounded risks, like LTCM, for example, right, which was very similar in a lot of ways to Bill Gross. I mean, they were extremely bright. They knew what they were doing. They were very focused and nimble traders, and they were quite good at structuring their trades. I mean, I think that's another very good point that you made in the article, which is that you can come up with a great idea, but that's only part of it. You also have to be able to communicate it and structure it. And there's no doubt that PIMCO was very good at communicating and structuring it. But I just have to wonder that if we had seen, like you saw the basic failure that he experienced in the taper tantrum about 10 years ago, and look at what's happening this first quarter or first 4 or 5 months of 2022, which is awesome that it coincides with your book coming out.
I know, right? I didn't mean to do that.
Yeah, right. That's just amazing timing on your part. But you'd have to imagine that this strategy would be getting killed right now, right?
I mean, yeah. And I will note that there's a big difference between LTCM and Bill Gross, and that's that Bill Gross never blew up, right? He avoided ruin. So there is
he did.
Underlying,
because he wasn't as leveraged, right? I mean,
yes, but that's a real thing. I mean,
it is for sure. The structuring part.
Yeah, the structuring part. And that's what's critical. So yes, these, and there is some evidence in the 2019 study that he seemed to lean in a little wrong. He seemed to get he didn't take duration risk right when he should have. In fact, they found a little bit of evidence to the contrary. So it's possible I'm wrong here. It's possible that I'm overstating things or rose glasses a little bit here. But I think that he avoided ruin. This is a fundamental thing of his risk management strategy of what he learned at Vegas, card counting and kind of adhering to the Kelly criterion of, knowing when you have the odds in your favor and leaning in only then. And I think, there are certainly years where he didn't do that. And, his tenure at Janus is certainly one of those. His, 2011 Treasury call seems to be one of those. There are moments where he seems to have deviated from his risk management. But that structuring point, I mean, to some extent, they were limited in how risky they could be just by virtue of the mutual fund wrapper. But I do think, a lot of the heroes of the financial crisis, people who saw it and traded it right, a lot of those trades were bananas. A lot of those trades were terrifying. Everyone's like, oh, Michael Burry is this big hero who stopped talking to his investors. And that's all of the
it's a totally different thing. Yeah.
It's a totally different thing. And the way that they were structured, I would say a lot of these, ones that we talk about in The Big Short and otherwise are a lot riskier in a way that, I don't know, was it an informed risk? Did they know that the timing was going to work out exactly the way that it did? Or were they lucky? So I think, the fact that PIMCO's crisis trade was ramped down on risk and then be able to scoop things up in the aftermath, that's so much safer sounding to me. It's the avoid ruin part that to me is the counter to your. It was just this was actually truly luck, right? That it was skill within luck. I think Yes, but the avoid ruin part did come up and does kind of mitigate that because there were blips along the way. Did he trade all of them perfectly? No, absolutely not. But I do think that, it is a critical difference that he avoided. There even in 2011, I don't think he lost money. Like that was
he just lagged.
Spectacularly wrong
Right.
call, and he just lagged.
He just lagged. So that would be my point. That would be my point, was that you're 100% correct that avoiding ruin is jobs 1, 2, and 3, and he did a great job there. And I didn't mean to compare LTCM in the sense of
no. You just gave me an opening there. Don't worry.
A total blow up. My point was that the idea of skill and IQ and trading prowess is insufficient, right? Because it's
absolutely
not enough.
True.
It's not enough to have that to avoid blowing up. And my ultimate counter to this would be that even he himself said in 2013, in April 2013, you quote this right at the beginning, he looked in the proverbial mirror and asked himself, am I a great investor? And this was in his public note. And he said, no, not yet. And that was because he himself felt that he and his peers were untested. And I would argue that the current period, like literally the last 6 months, would be one of those tests that he never got to quite experience. And that if you were using this same framework, and let's give him full credit, maybe what happened in COVID would have caused him to change his strategy, right? Maybe he would have said it no longer makes sense to sell volatility because this is just so crazy. And somebody that smart and that nimble very well could have made that calculation and that change, that tactical shift. But we just don't know. And so my point would be that if he had kept that same keys to the kingdom approach, right, where and I don't think the factors that they sussed out in that study attributed causation among the three. But I would guess that being long duration and short volatility was probably the lion's share of the outperformance, and that he would have given back a lot of that outperformance just in the last 6 months, right? I mean, I think the last 6 months would have not necessarily blown anything up. It wouldn't have gone to zero or required a big bailout like LTCM, but it may have well blown a giant hole in the track record, right?
I think that's probably right. And, it is like I'm kind of sad now that you're saying that's like we'll never know. We'll never
You'll never know. No, exactly. You never have a parallel universe.
I thought I had an answer. I was so happy. No, I think you're right. Like it is a new period. And I did kind of wonder, I put this to a lot of people who know his strategies well, who worked with him or observed him very closely. The period after 2013, I had this sense that it was kind of, and I wrote this in the book and then realized that I was like, the rally, the bull market for bonds was over as of 2013. And people were like, Mary, rates are lower, girl. Right. And I was like, oh, that's true. But from the day that Bill took over the Janus fund to the day he announced his retirement, the 10-year went up. The yield on the 10-year bond went
2.43 to 2.73 is your article points out. Yeah.
So you're right. That it's a little instructive because his track record, he did not replicate it at Janus. He did not manage to outperform at Janus. And it was in a rising rate environment for his experience. So it's is that sufficient evidence to undermine all of the decades that came before? Maybe. Probably not. I don't know. I would land on probably not, but you're right that it is kind of it's not evidence. So,
and that's where I find a simple factor analysis to be just oversimplified in a lot of ways, because if you really want to compare a long multi-decade track record, to what Buffett's done at Berkshire, every 10 years or so, he completely shifted tactics. The principles never changed, but the tactics definitely changed, right? Both out of necessity by the size of the company and the size of the capital base that he was deploying, and based on the market opportunities that were presented to him. Yeah. And so that's what I think is also so fascinating about this, counterfactual we'll never have an answer to, is because we just don't know. I mean, like I said, maybe he would have been smart enough to realize, wait a minute, with excess liquidity flooding the market for years on end and all these earthquakes building underneath the surface and rates completely pinned to the floor, there's no prudent way to sell volatility anymore. This is just crazy. I'm picking up pennies in front of a steamroller and I have to get out of the way.
Right. So, and that maybe, there are, I think about the cash and cash equivalent exploitation where you invest in short dated, corporate floaters or whatever. And it's funny because there was this debate at one time, there's always a line as to what can count for a cash equivalent. And it's a bit subjective. And at times they were I don't know, is this Russian floater cash equivalent? And I think they got a bit caught out in the whole war thing. And I think that is, sometimes that, if you're buying Campbell's soup, allegedly, I was told Paul McCulley could never get enough of Campbell's soup short dated notes, like give them to Paul and, for the cash management desk. And it's like that makes sense. Like that probably would still work. You're going to get a bit of notice before Campbell's soup, files. That's not always true, but it's almost always true. So I feel like there's some that would still work, but yeah, I wouldn't want to be selling vol in March 2020.
No, right. Or December of 2021, right? I mean,
today,
yeah. I mean, it's just been horrendous. I mean, it's been probably the worst 4 or 5 month stretch in the bond market in my lifetime, and I think unequivocally. The cash equivalent thing is a fascinating example of it, right? Because it's something that Berkshire famously avoids, right? I mean, they use Treasury bills. That's it, right? I mean, he has absolutely no interest in even AAA rated commercial paper because GE was, a big supplier of highly rated commercial paper until the financial crisis rolled around and everybody realized that GE Capital was not what they thought it was. And it's just not worth
the most liquid credit default swap. Yeah.
Correct. Yeah. In that construct, it's not worth taking the extra risk for an infinitesimal little bit of return. And so that's where it's so fascinating because he was so good at picking up these little basis points here and there.
Right. And that is skill.
And not blowing up. Yeah, no, there's a lot of skill involved in it. I just, to be definitive about it
is impossible.
It is impossible. And
it's a bit of a game that we're playing. Yeah.
It's arbitrary at one point. But I would highly, highly encourage everybody to check out that article from last week because no matter where you are in the investing business, this is a debate that is endlessly fascinating and that you should be thinking about. And I would highly encourage everybody to pick up the book for the financial history and the thought-provoking nature of where markets have been and where they're going, and as well for the jaw-dropping, details that come along the way. So congratulations on the book again. I thought it was great. So thank you. I know we're up against time, so thank you again for joining us, and we'll look to have you back on the future. All right. Thanks again.
That. Take care. Thank you.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.